Here's the core judgment. Meta is not broken, but it is repricing. And the repricing is not yet done. On March 26th, Meta stock fell approximately 8% in a single session. That is the worst single-day decline in close to a year. The immediate headlines blamed the legal verdicts. But if you look at what actually converged that day, you realize the sell-off was telling you something more important than any one verdict could. Three separate forces arrived at the same moment. A Los Angeles jury ruled Meta and YouTube negligent in contributing to a young woman's mental health harm through addictive platform design, awarding $6 million in damages with Meta assigned 70% of responsibility. Separately, a New Mexico jury found Meta liable for violating state consumer protection laws related to child safety, ordering the company to pay $375 million, the maximum allowed under state law. On the same day, Meta confirmed it was cutting approximately 700 jobs across Reality Labs, Facebook, global operations, and sales. And analysts began trimming price targets. The stock, already down roughly 17% year-to-date, now sits nearly 31% below its all-time high of $796 reached in August 2025. That is the compressed version of events. Now here is what actually matters. The financial penalties from the court cases are, in isolation, almost irrelevant. Meta reported $201 billion in sales last year. The combined verdicts total $381 million. That is less than 0.2% of annual revenue. When analysts at CNBC called the New Mexico penalty a slap on the wrist for a company with a $1.5 trillion market cap and over $60 billion in annual net income, they were doing the arithmetic correctly. If this were only about the damages, the stock would have barely moved. So why did it fall 8%? Because investors were not pricing the fines. They were pricing the precedent. This is the point most people are missing. And it is the reversal card in this story. Meta and its peers have operated for decades under Section 230 of the 1996 Communications Decency Act, the legal shield that protects platforms from liability for user-generated content. What these verdicts represent, for the first time in a sustained, multi-court pattern, is successful plaintiff arguments that pierce that shield by focusing not on the content itself, but on the design of the platform. The plaintiffs did not need to prove that social media caused harm. They only needed to prove it was a substantial factor. Juries in two separate states, with two separate legal theories, agreed within days of each other. Harvard Law lecturer Timothy Edgar called it a major watershed event, a big shift in how Americans are viewing big tech. Legal observers are explicitly drawing the comparison to the tobacco industry's 1990s reckoning, a moment when what had been an unbeatable legal defense collapsed under the weight of accumulating evidence and jury skepticism. Meta and other social media companies now face more than 400 similar cases, centralized before a single federal judge in California, with thousands more in state court. The bellwether verdicts are specifically designed to shape the resolution of that entire wave of litigation. The stock market understood that context immediately, which is why Reddit, Snap, and Pinterest all fell 10% or more on the same day. This was a sector repricing event, not a company-specific one. Now layer the second force on top of that. Meta has guided for $115 to $135 billion in capital expenditures for 2026 alone. For context, total costs and expenses grew 40% year-over-year in the fourth quarter of 2025, compressing the operating margin from 48% down to 41%. Long-term debt has grown to $58.7 billion from $28.8 billion a year ago. The company is simultaneously cutting 700 jobs, the latest in a series of reductions that have totaled approximately 25,000 since 2022, while committing to one of the largest infrastructure build-outs in corporate history. That is a narrative that is very difficult to communicate to investors. Cutting workers while raising spending signals that management sees the value being created in infrastructure, not headcount. But it also raises an uncomfortable question. If the AI spending is generating returns, why are margins compressing? Here is where the hidden paradox sharpens into focus. Unlike Amazon, Google, and Microsoft, Meta does not have a cloud business. It cannot sell excess compute capacity to third parties. Its AI infrastructure spending is a pure cost, not a revenue-generating asset with an external market. Every dollar Meta spends on data centers is a bet that those capabilities will eventually make its advertising engine, which already accounts for the overwhelming majority of its revenue, meaningfully better and more defensible. The bull case is not crazy. Meta has 3.58 billion daily active people across its family of apps. Ad revenue grew 24% year over year in the fourth quarter of 2025. The advertising flywheel is real and powerful, but the return timeline on AI infrastructure is genuinely uncertain, and the company has not yet shown a significant new revenue stream that AI has unlocked beyond incremental advertising improvements. The CapEx story also has a dimension that has received surprisingly little attention. Meta recently signed a 5-year, $27 billion capacity deal with neocloud specialist Nebius Group, committing to $12 billion of dedicated capacity powered by NVIDIA's Vera Rubin GPU architecture, with an option to purchase an additional $15 billion in capacity. Separately, the company is building Hyperion, a 250-acre, 4 million square foot AI data center in rural Louisiana, representing a $10 billion investment, its largest to date. The Hyperion project alone is transforming Richland Parish in northeast Louisiana into what residents describe as a chaotic boomtown, with truck traffic damaging local roads, housing costs climbing as landlords capitalize on the influx of construction workers, and thousands of workers operating around the clock on a site 5 miles long and a mile wide. Collectively, tech hyperscalers are projected to invest $630 to $700 billion in 2026 alone, a 62% jump from 2025, with total AI-related data center spending expected to reach $5.2 trillion by 2030. Bernie Sanders and Alexandria Ocasio-Cortez have already proposed a moratorium on new data center development. The political and regulatory surface area around AI infrastructure is expanding, not contracting. And then there is Reality Labs. The division has accumulated $76.9 billion in cumulative losses since 2021. The 700 jobs cut this week are the latest in a series of reductions that have substantially hollowed out that division. This matters for the AI thesis in a specific way. The smart glasses product, the Ray-Ban Meta collaboration, was supposed to represent a convergence point for Meta's hardware ambitions and its AI capabilities. A new federal lawsuit now alleges that Meta is routing footage captured by those glasses to human contractors in Kenya who have reportedly seen users undressing, viewing sensitive financial documents, and other private moments, all through an opt-in data sharing program that many users did not understand in the way Meta's marketing implied. The lawsuit was filed in March, and it arrives at the worst possible moment when Meta's legal credibility with juries and regulators is already under scrutiny. Now here is where the scenario branching becomes essential, because the range of outcomes from this convergence point is genuinely wide. If the legal wave does not escalate beyond manageable levels, if appeals courts narrow the Section 230 rulings, if punitive damages in the pending cases remain proportionate, if the federal bellwether trial in Northern California this summer does not produce a catastrophic verdict, then the current sell-off looks like a sentiment-driven overreaction to a manageable legal exposure. In that scenario, the advertising business continues to compound. The AI infrastructure spending eventually translates into measurable efficiency gains and new ad targeting capabilities, and the stock's forward price-to-earnings ratio of roughly 20 times. Not expensive for a company growing revenue at this pace, according to analysts, reasserts itself. The analyst community currently holds 62 buy ratings and 0 sell ratings on Meta, with a consensus price target of $864. That is a substantial gap from current levels. If the legal risk gets contained and the AI spending shows early returns, that gap closes. But if the legal trajectory continues to build, if the summer federal trial goes against the platforms, if punitive damages in the existing cases come in at the high end, if Section 230 reform gains legislative momentum in a politically hostile environment for big tech, then Meta is facing something that looks more like the tobacco industry's structural repricing than a temporary setback. In that scenario, the advertising model itself comes under pressure, not just from legal costs, but from potential design mandates, algorithm restrictions, and reputational damage that affects user engagement. And if user engagement softens while CapEx commitments of $115 to $135 billion remain fixed, margin compression becomes severe. In that scenario, the 31% decline from the all-time high is not the bottom. The recovery path, however, does not require a legal victory. It requires a clarity event. Options traders are currently pricing in sustained uncertainty, with put-to-call ratios shifting defensive and implied volatility elevated. What the market is waiting for is not necessarily good news. It is the reduction of uncertainty. If even one or two of the major forthcoming legal cases settle on manageable terms, the uncertainty premium in the stock compresses significantly. If Meta demonstrates in its next earnings report that ad revenue growth is holding above 20%, despite all of this noise, the AI CapEx story shifts from an unproven cost to a defensible investment. The company has navigated existential-sounding threats before: Cambridge Analytica, the iOS privacy changes, the original metaverse skepticism, and each time the advertising engine absorbed the impact and kept growing. The one-line wrap: Meta is not a value trap yet, but it is one bad legal summer away from becoming one. And the next 6 months will decide which story this actually is.